property tax is one of the largest recurring expense that taxpayers face today. Property tax is an annual tax that's levied on real property, which is your land and building, like your house, and on business personal property, which is like the equipment, machinery that companies own that they use to produce income. But those taxes are the ones that actually fund your schools in your local community. It funds infrastructure. It also funds like the police and the fire department. And so anytime you have, issues with, oh, we're not going to make our budget, or schools are not going to be fully funded, it comes directly back to property tax.
Hello, everyone, and welcome to the SALTovation Podcast. Today, we have Marcia Shippey-Pryce here today to talk to us about property tax. And I am really excited. I'm going to be really vulnerable here for a second. Property tax is not something I know a lot about, other than Denver keeps raising mine year over year. So really looking forward to this conversation with Marcia to educate me, Stacey, and our listeners just on what she's doing, why it matters, because I know it does. I just don't know how. So, Marcia, thank you so much for being with us today on the SALTovation Podcast. It's great to have you here and to meet you and to have this conversation.
Thanks, Meredith, and thanks for inviting me. Happy to be here.
So, as we usually do, can you please explain a little bit about your career and your background and kind of get us to how, you're here today being the master of property tax?
Well, I'll try to be as succinct as possible. As I say, no one grows up and say, "Hey, when I grow up, I want to be a property tax professional." But somehow I got here, and I got here the right way. I started my career actually in the military. Spent 3 years in active army, 5 years in the National Guard. And so, while I was spending my stint in the National Guard, I went to school. I went to college. The Army paid for my college education. And so I went to college, and I had the goal of becoming a real estate attorney. And so while I was going to college, I got a job, was also working full time at a manufacturing company, which I had the opportunity to be a tax specialist. I'm not even sure how I fell into that role. But part of my responsibility was sales and use tax and property tax. And I grew so much to love property tax. And so, at my graduation, I got recruited by a Big Four accounting firm to work in their property tax practice in another state in Georgia. I was in Florida at the time. And that really started my career in property tax. And I had the opportunity to work with one of the largest manufacturers in the world. That was my client at the time at such an early time in my career. That really formed and developed who I am today in terms of the breadth of experience, the depth of experience, and the experience in the multiple jurisdictions across the US. And so, I spent some time in consulting, but I also spent significant time in industry, where I led the compliance group for property tax and also ended up leading the indirect tax group for a leading paper and packaging manufacturing company that had, several locations all across the US. So I had the opportunity of developing relationships with the assessing jurisdictions and understanding those requirements and being able to be well-rounded both in real property and business personal property. And so, of course, I had the opportunity to come to Aprio to help lead the property tax practice and develop it. And I'm so excited to be here, and I'm looking forward to what the future holds.
Well, yeah, and I love that it was just, I just am ready to work. I don't really care what it is. Like you said, not quite sure how you ended up, like maybe even at a manufacturing company, but then certainly in charge of sales tax and property tax, but it just clicked. So it's kind of like all of the stars aligned. And that's kind of how it was with me too. And it was just like, I don't care. I just want to work. Like, give me something to do. And then if it doesn't work, I'll shift. But like it just clicked. So I love that. And just hearing about kind of that passion that was created just kind of from the get-go. Um, but if you wouldn't mind taking a
Mhm.
step back and talking about, okay, well, what is property tax? And realistically, like, why do we care? Question mark. Um,
So, let me start about why do we care
okay,
about
let's
property
do it.
tax? It touches our every fabric of our life here. So, property tax is an annual tax that's levied on real property, which is your land and building, like your house, right?
Mhm.
And on business personal property, which is like the equipment, machinery that companies own that they use to produce income, right? And that tax is levied annually on the value of property. So it's a little bit different from other taxes. Another word for property tax is also ad valorem, meaning according to value. It's the Latin for according to value. And so the millage or tax rate is applied to what the value of the property is, the assessed value, to calculate how much tax is owed on the property. And a lot of times, a lot of people are very familiar with that because, if you own your home,
Right.
you're paying real estate taxes. But those taxes are the ones that actually fund your schools in your local community. It funds infrastructure, right? Building in your community. It also funds like the police and the fire department in your communities. And so property tax is local. And so anytime you have, issues with, oh, we're not going to make our budget, or schools are not going to be fully funded, it comes directly back to property tax. And property tax is one of the largest recurring expense that taxpayers face today.
And it's also one of the bigger revenue generators for jurisdictions in general,
Correct,
right?
correct,
I
correct.
think
And
there's some kind of there's sometimes misnomers where I think taxpayers might think that, oh, sales tax drives or income tax drives, but it's generally property tax, correct?
it's generally property tax. So if you look at the revenue collected by state and local governments, property tax is about 36% of that revenue, which is larger than sales and use tax, state and income tax. So it is very, taxpayers want to watch their bottom line when it comes to property tax.
Rightly so.
So then, when it comes to the real property, is there a in like business personal property? Do jurisdictions always have a personal property tax? Or do you find that like that may be an item that they don't have, or but everyone kind of has the real property component? Like from an assessment or a applicability standpoint, are they kind of equal?
You know what? Everyone pays real estate
Right.
taxes. That's the property tax. So if you have a home, if you have a business that you own the land and building, whichever state you're in, they're going to tax you for that.
Right.
Now, for business personal property, there are some states that actually exempt business personal taxes. So, like Pennsylvania, New York doesn't have business personal, Minnesota, right? But you also have to be careful in some of those states. They may not tax like your regular commercial business personal property, but if you have a utility company, right? And that's what you call central assessment, right? They may tax like your utility plant, right? They may tax certain businesses that are for public necessity. They may tax those for business personal property. So there's about 12, 13 states that don't have business personal property. And actually, the trend now, there are like tons of bills sitting out there with states trying to get rid of business personal property, because it's going to be an uphill battle because they do have to find a replacement to fill in that lost revenue. So we're watching it. What some states are really doing, they're trying to increase their business personal property exemption in terms of if you have property and it's valued under a certain amount, then you're not subject to property tax. That's kind of the middle ground that some states are taking. Like for example, Texas came up with their kind of like a de minimis exemption. Georgia just passed last year in the election. If you have value under 20,000, you don't have to pay business personal property tax. Florida already had in place that 25,000 value exemption, and of course, California has that $100,000 in cost exemption. If you have lower than that, then you're not subject to business personal property tax. So there's states with all these de minimis exemption, and that's really catered towards like smaller businesses to
Right.
kind of protect. Yeah.
Yeah, so it's not as if they're getting rid of the ability to impose the tax, but it's just that, hey, we'll increase, right, your requirement to have to do so
Correct.
to
Correct.
alleviate, the burden on small businesses. Because I think Denver,
Correct. They have a one where it's about $56,000 in exemption. So if your value is lower, full cash value is lower than that, then you're not subject to business personal property tax.
since you brought it up, and we love kind of like things to look out for, what other trends are you seeing when it comes to property tax, either on kind of the real side or the business personal property side?
Sure. A lot of states are also looking at how to cap increases, because I'm pretty sure you've heard, you know, folks probably say, why is my real property tax so high? Why has it increased so significantly this year? So a lot of states are looking into how can they cap that increase, right? So for example, can we pass a bill to say, hey, your property taxes can't be increased more than 2% per year, right? Or 3% a year, or 5% over a certain number of years. So that's the trend that we're seeing right now. And then also we are seeing a trend, recently, all these data centers are popping up.
Mm-hmm.
Jurisdictions are really trying to figure out how to get a handle on these, how to tax them, because some of these jurisdictions have never seen this type of property. They have all these high-end, high-tech computer inside, but they're using all this energy. How do we value this? Do we value it as an income producing property? Do we look at it as a cost approach methodology property? So there's a lot of things going on there, and a lot of states are really looking into that and kind of working out how do we value those types of properties.
Well, and I think just in general, the value piece kind of seems like a mystery. And so I don't know, Marcia, if you can maybe speak to some of the different methodologies that are put in place and what, maybe taxpayers can, look out for.
Great question, Stacey. So in property tax, there are typically three ways to value property, right? You have the cost approach, meaning from a business property perspective, you're going to be reporting the cost that you paid for your assets, right? And then it's going to be depreciated by a set of depreciation schedule used by the jurisdiction. Sometimes it's a set schedule used across all counties or all assessing jurisdictions. And sometimes even the local jurisdictions have their own depreciation schedules. So it's not like income tax or something
Like
that
a
you're like,
5-year
okay,
makers that's like 20%,
really,
then 34, then
exactly. So you really have to know what's going on in the jurisdiction that you're located in, and how to apply those depreciation to the assets that you own, and then that derives a value. In some states, when you derive that value, 100% of that value is taxable. But you have other states that have what you call an assessment ratio. So they don't tax you on the 100% value of your property. It may be 40% of that value. So for example, Georgia, 40% of that value is taxable, or Tennessee, 30% of that value is taxable, right? And so the tax rate, or what they call a millage rate, is applied to that value to calculate the taxes. So that's kind of how the cost approach rolls in, right? For business
Why would
property.
why would a jurisdiction only look at 30% or 40%, some kind of percentage? Is that to really kind of give taxpayers a little bit of a break, or what's the theory behind that?
So it's also tricky. So I usually try not to spend too much time on those assessment ratio, because they may give you the assessment ratio to think you're getting a big break, right?
Sure.
Um,
Yeah. They're
However,
spinning it however they want to. Yeah.
I look at it, I usually, when I look at, for example, if a client calls and asks, okay, which state should I put my property in for business personal property? I look at the 100%, I look at the effective tax rate. So basically, what would the rate be, right? If I equalize everything across the board, right? Taxes, right? And the 100% fair market value. What would that equal to? Because sometimes you can have an assessment ratio and it looks like, oh, only 40% of this value is taxable, but the tax rate is like 5%. Or 33%.
Right.
So that negates the whole benefit,
Sure.
right?
Sure.
Of getting an assessment ratio.
And that's fair, because I mean, Meredith and I don't play in the property tax space, as you can tell. But we get similar questions like with income tax and sales tax, right? Like, where should we move so that we're not going to, pay as much income tax? And we're like, well, okay, you're kind of maybe trading one tax for another. So
Correct.
you're explaining something very similar with the property tax rate.
So we just look
ratio.
at the effective tax rate.
Yeah.
And so that's for the business personal property with the cost approach. Now for the real property, you use the cost approach when you have like newer properties, where you can say, okay, I paid this for the material, labor, and all that stuff that goes into building the property. Or like unique properties that you don't find every day. You use a cost approach, meaning you say, okay, how much it costs to build this, do a replacement cost of it, less depreciation, and then add back in the land, right? And you get your value there. Now you also have what you call the income approach, and this is usually used on like, apartment buildings, right? Retail store, right? You have income coming in, and you really capitalize that net operating income to come up with a value, right? It's a cap rate based on the industry and sometimes even the location, because you can have different cap rates for different areas, just basically based on what's going on. How's the market, right? How's the demand in those areas, right? So that's the income approach. And then the other one is what you're probably more familiar with, is like your sales and market approach. And this you see a lot in like residential area, like how much did that house sell for down the road? So basically looking at what a comparable property would be sold for on the market between a willing buyer and seller, right? An open market. And then you look at that and say, okay, and you even look at rents, like the rent per square foot, right? That we see going here. What is that compared to the property that you're comparing that to in order to come up with a value? Right. So if the property is like 1,000 square foot and the value is $10 per square foot on the market, right? So we have an estimate of what the value should be for that property.
One, I guess, that makes a lot of sense when you think about data centers, right? Because they are, like you said, really, really capital intensive. You have very expensive, servers and racks and fans to make sure the whole thing doesn't overheat, and then the security systems to monitor it and all that. So there's an incredible amount of cost there, but also that's the product in which people are buying, right?
Correct.
And so is there one that you think is kind of winning? If you were to completely genericize this, would you say that there's one kind of method that's winning, that states are picking, like the cost or that income approach?
with property tax, I'm going to use this word, and you probably hear it in sales and use tax sometimes. It
There you go.
depends. So it depends on the type of property, right? It depends on where it's located. It depends on the jurisdiction. So the decision is not made at the state level.
Right.
Everything is local. So you could be in the same state and you have two different jurisdictions may value a data center. One may be on the income approach, one may be on the cost approach, right? And then sometimes you have jurisdictions they may take all those three approaches and do a weighted average to determine what the value is. So they may say, okay, I'm going to weight the cost approach value 40%. I'm going to weight the income approach value, 30%, right? And then cost approach 30%, right? And so they get a weighted average to come up with a value. So it just depends on the jurisdiction that you're in and the type of property that's being subjected to valuation.
Well, and when you look at an asset that you've got to assign either, cost or value or income, is it all of the pieces and parts, or is it kind of what you have to do to kind of make it usable, right? If you think about a computer when they weren't all like laptops, right? If you had a tower, you had a monitor, you had the cords that connected the two, you had, a keyboard and a mouse in order to make that work. Is it the, kind of sum of all of those parts and that's what makes up the computer? Or is it like, you're valuing the tower separately, the monitor separately, the cords separately? So how do you define the asset in which you're assigning value?
So typically for business personal property, the cost approach is used predominantly, right? Because you have a cost on your fixed asset listing, right? You have a cost in your financial records for that asset. And so it's important. And this is where it's so important for taxpayers, right? And our clients to make sure that when they're booking their assets, they try not to consolidate or commingle assets together, but kind of list them in their own classification. If it's computer type equipment, keep the computer equipment to themselves, right? Because then you get a better depreciation applied to each of those assets. When you're reporting, you have to report all the assets, but it's not one number that goes on there. They're looking at each asset that's being reflected on your fixed asset listing. And so based on the description of the asset, and sometimes, I see a lot of taxpayers depend on their GL account description in order to determine what depreciation to apply to those assets. But sometimes we're all humans. Errors are made and, assets get classified to the wrong GL account description, right? And sometimes you really have to eyeball the asset description to make sure that it's being, the right depreciation is being applied to it to derive the value. So it's really looking at the individual assets.
What about if that asset moves?
Okay, so if that asset's moved, so with property tax, you have what we call an assessment lien date. And for most jurisdiction, that assessment lien date is January 1st, right? Except for a few like Alabama, right? It's October 1st. And then you have like Nevada, July 1st. But for most jurisdictions, it's January 1st. So you're really looking at where was the asset as of January 1? And who owned the asset as of January 1? So that's the person who's going to be responsible for the property taxes. And that's the jurisdiction in which the property will be valued and assessed. So if you have assets moving, you really have to pay attention to where those assets are as of that assessment lien date.
Yeah, I think we see, there's plenty of industries where this happens, but, we've gotten questions over, our careers about, particularly in the construction industry, right? Where there's heavy equipment that's moving from one place to another. Even within the same general location, right? But it could end up, to your earlier point, it could end up in a different jurisdiction for property tax purposes, even though it's down the road.
Correct. From a taxing district, so maybe even in the same county, but they may be in different taxing districts. So the tax rates may look totally different, right? You may have one equipment sitting in a city with a high tax rate, right? And then one sitting, what you call the unincorporated area of the county that has a much lower tax rate. So it's really important to know where those assets are sitting as of the assessment lien.